The concentration continues. And what do we mean by the concentration? We mean the concentration of the market rally that has gone so far this year, and particularly has gone on incredibly strongly since SVB failed and people thought the Fed was done for the fifth time in a row or something. And tech stocks have obviously flown. But it hasn't been a broad win. And tech stocks have actually been the ones most hit in terms of an earnings decline so far this year, but we'll get to that later in the video. We want to talk about how the concentration continues. I mean, you look at it today. Today was essentially a reversal of yesterday. Yesterday, we finally saw some weakening in the mega cap, the select seven, we'll call them. And we saw strength in the Russell, in many other sectors that were economically sensitive, and yields were lower, and the dollar was weaker. Today, we saw literally the exact opposite. We saw a very concentrated batch of stocks up, and it wasn't just tech. It wasn't just the NASDAQ. There were more new lows than new highs for the NASDAQ today, and that's been the same for the past 3 days, two of which the NASDAQ was down, one of which the NASDAQ is up. The equal-weighted S&P definitely underperforming in a very meaningful way. The S&P 500. And in the final stages of the rally, the bulls correctly pointed out that the divergence was broadening out. Finally, it wasn't that the equal-weighted S&P 500 was only flat on the year, while the whole market overall was up double digits. And the Select 7 has several stocks up well over 100% this year. I think all of them are up at least 50% or some very large number like that. Maybe Apple isn't up 50%, but they're up 30 or 40 healthily into double-digit territory. And that stock barely really broke down and has traded above historical multiples and historical post-buyback beginning multiples as well, by the way. Anyways, the important thing is we had a broadening out for about 3 or 4 days, and it was a very strong burst of a buying out or broadening out. It only lasted 3 or 4 days, and we've given up about half of that so far, and that came after the idea was that we were going to pause. But the Fed didn't want to leave us in that notion of a pause. They wanted to deliver the idea of 2 more hikes. This was not something they did after SVB, I believe. They did make the dot plot more hawkish after SVB, but I don't think it was a surprise. I don't think they surprised the market like they did this time, and deliberately so. And don't question this, okay? People have been questioning it for several months, almost a year, really since August. That's why the August correction was so large, because Powell had to come and correct the market. He's trying to do that. He's saying today that there's a firm and strong consensus amongst the majority of FOMC participants that they need to hike at least 2 more times. And he's not talking about rate cuts. He's not doing, honestly, anything dovish. There's nothing dovish here. And, it's late in the tightening cycle. So I will grant you that 25 basis points, not really such an important thing on the surface of it. Yes, it is a higher interest rate. Yes, it will affect everything. Yes, the full effects of that haven't played out. Yes, the full effects of that hadn't played out in the bond market. So interest rates are going to go higher. And we know there's a very strong correlation between market tops and market bottoms and stock in yields and stocks. It's not perfect. It's not day for day, but it's pretty damn close within a couple weeks or so, something like that. Anyways, why additional rate hikes are important is because what is the goal of these additional rate hikes? What is somebody who wants to pause, like Bostic, saying would get him to do additional rate hikes? Rate hikes are now becoming more important because of their direct effects on constricting the economy. Let's not forget, the whole reason why we were able to shut down the economy, go through coronavirus, and have a strong economy, and have a strong recovery and near record low unemployment is because interest rates were very low and the Fed was engaging in quantitative easing. Now, they're engaging in quantitative tightening and raising interest rates. So what is that going to do? It's going to have the opposite effect on the economy as it did during COVID. And this is why I think multiples have to be lower than the same levels, and levels have only been higher in the COVID bubble and the dot-com bubble. So, I think there's plenty of fairly obvious reasons why stocks are expensive and probably need to turn around because, yes, Nvidia was a surprise, but Tesla, just a few weeks ago, surprised negatively on earnings. The CEO of that company is telling you it's going to be rough for the stock going forward. He said specifically he didn't want to make it all, only about positive things because there were definitely negative things on the horizon. And Elon Musk forecasts a recession. He thinks the Fed, for a while, has needed to stop because they've been going too far with the hikes. So, I'm not just some dude who's, failing to capitulate and, digging himself deeper in a hole and letting his ego get ahead of him, okay? There are a lot of very smart people who both agree and disagree with me. So, ultimately, we can't get too crazed out about a single day or even a single week or a single month. We have to let things play out. We need time to let our theses go. But I think with a market near all-time highs, broadly, and definitely in a concentrated few stocks, earnings declining, the SMH, the semiconductor ETF, back at all-time highs or just about to hit them, despite no longer being in a chip shortage, chips being a cyclical business, and prices likely continuing to come down. A bit of a stretch, I think, for the SMH to be back at all-time highs. Yes, AI is going to be great, but we've recently had a boom. We know what it looks like. We know how it affects bottom lines. Yes, Nvidia is individually doing well, but that is only one component of the SMH. It's a little questionable. These stocks are experiencing very clear and very obvious earnings declines. And we're about to enter earnings season again. I thought last earnings season was going to be a little bit more of a disappointment. If you look at where it was relative to expectations, it wasn't so much. If you look at where it was relative to where we were the last time the market was at this level, and keep in mind this is important because inflation, which was once a tailwind for earnings, is coming down. And is also important because the actual money supply is decreased, so this is a fair comparison. This is not comparing like 2007 to 1988. This is, this is just a year and a half ago. Okay, this is not that long ago, and a lot has changed. A lot has changed since then. Basically, everything about the soil has changed, literally. So, except, maybe car demand or something hasn't changed that much, but basically everything has changed. And even for that, look at Teslas. Before, Elon was saying, Tesla didn't have a demand problem; they had a supply problem. Well, now maybe they overplayed that hand. Now maybe they have too much supply capacity, invested too much in supply, and they're definitely building inventories and discounting prices. So I think they might have a little bit of a demand problem. Maybe, just maybe. Now maybe that has to do with interest rates. So I think there's a lot of things to consider. Today I view as simply a reversal of yesterday. snap back a little bit. I definitely see signs of weakness throughout the broader picture. And we'll see what happens. Let's see how the market plays out over the next coming days and weeks. So that's today's video, and until next time, peace out.